Economic Unit's latest outlook report shows Ghana among 16 out of 51 African nations that experienced a worsening operational risk between late 2022 and mid-2023. This and many more coming up shortly. Hello there, good evening. Welcome to Business Brief here on TV3. My name is Michael Obodu. Before we bring you our top story, let's check out some other stories that have been making the headlines in the world of business today.
Today in business, as market watchers had predicted, government recorded an oversubscription in the latest Treasury bill auction held on Friday after missing its target at the previous auction. Interest rates in the market have also surged to about 31.24%. Government realized about 3.2 billion cedis, representing a 5.6% oversubscription of its target. Ghana Extractive Industry Transparency Initiative has urged government to treat the country's carried interest in the mining sector as a share of production in order to maximize revenue. Currently, the country's carried interest in the sector is tied to dividends. The world's largest tech companies must comply with a sweeping new European law starting Friday that affects everything from social media moderation to targeted advertising and counterfeit goods in e-commerce, with possible ripple effects for the rest of the world. The unprecedented EU measures for online platforms will apply to companies including Amazon, Apple, Google, Meta, Microsoft, Snapchat, and TikTok.
Well, thank you for staying with us, and straight into our first story as the latest operational risk outlook by the Economist Intelligence Unit. Ghana is among 16 out of 51 African nations that experienced the worsened operational risk between the late 2022 and mid-2023. This is primarily attributed to a deterioration in the macroeconomic risk subcategory. The following Business News Tech report has more.
The report points out that the negative trend is influenced by the impact of escalating domestic consumer prices, with repercussions on business profit margins and also on exchange rate and monetary policies. Despite challenges posed by the Russia-Ukraine conflict and the lasting effects of the COVID-19 pandemic, the macroeconomic risk subcategory maintains its position as the best rated across the region, with an average score of 43, equivalent to a C rating. This is due to the region's relatively rapid economic growth driven by expanding populations. On a positive note, 11 out of 51 African countries have shown an improved risk outlook. Countries such as Tanzania, the Central African Republic, and Ethiopia are experiencing improvements due to specific factors unique to each nation. Ethiopia's stability has increased in line with the ongoing implementation of its peace accord after a 2-year civil war, while the Central African Republic secured an International Monetary Fund deal in April 2023. The report also highlights the potential for financial sector distress due to high and rising public debt levels and comparatively low levels of banking supervision and autonomy in the region.
Now, Fitch Solutions is projecting a relative stability in global crude oil prices at about $84 per barrel for the rest of the year. The projection, according to the research firm, is based on global economic shifts, including the impact of events like the Russia invasion of Ukraine. This report has the rest of the story. Global crude prices shot up to over $100 a barrel in 2022 due to the Russia-Ukraine war. However, prices have been relatively lower at about $80 a barrel this year. Ratings agency Fitch is predicting prices could remain around $84 a barrel for the rest of the year, attributing this to happenings on the global front. Energy analyst Dr. Yusuf Sulemana seems to agree with the forecast and has been providing more perspectives.
OPEC kingpin Saudi Arabia, they unilaterally announced 1 million barrel cuts, from the market, and Russia also followed suit. You remember Russia is also, the leader in OPEC plus. And Russia is about number 3, followed by Saudi Arabia, number 2, and US number 1 in terms of oil production globally. And so if Russia and Saudi Arabia should unite in this way, in terms of oil supply cuts, then the impact in the market is just going to be felt drastically, and that's what is happening. So the policy rate hikes on one side, and then the increment in, the cuts, the continuous cuts by OPEC and OPEC Plus on the other hand, is beginning to equilibrate. And if it stays like this, then we will likely see the oil in the 80s.
Dr. Sulemana is, however, concerned that the $80 region is still quite high and will cause inflation in the country to remain at worrying levels.
I think it is, the best for what the consumer pays at the pump. And bear in mind, whatever the consumer pays at the pump has direct impact on inflation. As long as we may not see rise in inflation, a rapid rise in inflation, with oil in the 80s, I don't expect us to see that massive drop or the drop that everybody expects to see in the inflation. So by what we could do as a nation, if you're a producer and an importer of finished product, like our market per se, the peculiar nature of our market, we have to work at a model where we are able to cascade some of the benefits, which are called the windfalls, that could potentially come from the upstream.
Now, the Ghana Extractive Industry Transparency Initiative has urged government to treat the country's carried interest in the mining sector as a share of production in order to maximize revenue. Currently, the country's carried interest in the sector is tied to dividends. The implication is that if a mining company does not pay dividends, it means the country loses out on revenue.
Our 10% stake is tied to dividends, which, in the view of the Ghana EI, marks a departure from the way we treat our carried interest in the oil and gas sector. As we speak, the Ministry of Finance has embarked on a project to harmonize the fiscal regime in the mining and oil and gas sector so that the treatment will be the same. But based on what we have discovered as EITI in the mining sector and the trends in dividend payments, we have made a recommendation to government to, as a matter of urgency, consider to treat the 10% carried interest in mining in the same way as it is treated in the oil sector, which is as a share of production. We are at a stage where the ministry now wants us to provide some empirical data to support our policy preference.
On that note, that will be all for Business Brief here on TV3. For more business stories, please check out our website, 3news.com. My name is Michael Obodu. Thank you for watching. As always, please stay safe.
Let's play some games. How about that? Cooking is still ongoing, but we have to play some games. It really doesn't add up to the total score, but of course, it adds to the spice here in the kitchen. There's only one contestant from Adisadel College today, so they will not be part of the games. But if we have St. Mary's here, please join me, St. Mary's. Join me, Ketasco.